Lucy, you're back. How was Israel?
It was great, thank you.
Did you have fun? Did you go with Barcy?
Did I go with my
Barcy.
No, I was there with my family. My cousin got married.
Oh,
Yeah.
I think there was some
There was a
level.
program, yeah, I saw that.
All I have to do 1 and 2 under construction.
Right.
Halfway through. Yeah, and then halfway through year 3.
Good, how are you?
Reaches stabilization. And then still off 6 year 4 onwards. Yeah. No. Year and a half.
Are you guys done?
Like it finishes construction during year 2.
Good, thank
And
you.
then
How was your trip?
thank you.
My trip was always excellent. Uh-oh, sorry. Shenzhen, you guys, has anyone been to Shenzhen aside from Mr. Yu?
Mr. Duh.
Mr. Duh, Mr. Duh doesn't count. Yeah.
Yeah, I went there.
Good to Shenzhen.
Yeah.
Pleasure. or-
Pleasure. I'm gonna do a trip this week.
We are through halfway through the class, huh? What will you do after the class is over? You start studying corporate finance? More?
Sorry.
We don't go by
Thank you.
email.
Yeah, what is it?
MR521. This is right now.
Yep.
Yeah.
Good. I got good. So I got 100 on there. Which I just thought you were put in the one that I pulled out.
It's like right now.
What, you don't like games, Gabby?
There's not much going on today.
Yeah.
There's whatever. And then look at it and do it. It's just like seems simple.
It's, yeah, it looks good.
And yeah, I'm not gonna do it. I can do it month by month. But I'll do it 2 years, like a year and a half, start doing them like. Stabilization, midway through year 3. And then after year 2, I would go off to and so in year 10. There's much else to do.
If you want to go on, where you did like divide by two.
Yeah.
Instead of that, like it's better to like have that as an assumption somewhere so that you can change it easily.
What do you mean?
So like say like you have like 50% here and you like times that by like.
Yeah, I know. That's the idea. But nothing needs to change these to real days. And then have it linked to this.
Yeah. Yeah.
Yeah, all the other ones. All the other ones are always.
Yeah.
我今天早上睡歪了，我晚上睡歪了，干什么？今天非常好，这个才有遗憾。
Is that awesome? Thank you so much.
然后2块钱。 是没有看过的。多少没合了，不太容易合。
Just backing up into using whatever like I need an IR like 10% there before I can take this.
Okay, let's get started. So, let's go through, first thing we'll do today is go through the correct answers for problem set 1. Right? I did not share that with you yet. The second thing we will do is we'll go through, do the recitation for the midterm exam. And as part of that, we'll try to solve conceptual issues with the question. And then you will be able to resubmit your midterm exam answers online. Put the phone away, please, Debbie. So what we will do is, you can submit your answers for the midterm exam again after this recitation by 8 p.m. tomorrow. I have already sent you the URL for submitting your online answer forms, okay? And then we will dive into corporate debt. Have you brought your exam problem set 1s and midterms with you? Okay, perfect. So, problem set 1, the correct answers are we already did the recitation for problem set 1, right? So we don't, let's just go to the answers, correct answers. Is everyone ready? Who is not ready? Number 1, Bravo, B. Number 2, Delta. Number 3, Alpha. Number 4, Charlie. Number 5, Delta. Number 6, Bravo. Number 7, Alpha. Number 8, Bravo. Number 9, Alpha. Number 10, Delta. Number 11, Charlie. Number 12, Bravo. Number 13, Bravo. Number 14, Charlie. Number 15, Alpha. 16, Delta. 17, Alpha. 18, Charlie. 19, Delta. 20, Alpha. 21, Delta. 22, Alpha. 23, Bravo. 24, Charlie. 25, Delta. 26, Charlie. 27, Alpha. 28, Delta. 29, Bravo. 30, Charlie. 31, Alpha. 32, Delta. 33, Bravo. 34, Delta. 35, Delta. 36, Alpha. 37, Alpha. 38, Charlie. 39, Bravo. 40, Delta. 41, Alpha. 42, Charlie. 43, Bravo. 44, Bravo. 45, Charlie. 46, Alpha. 47, Delta. 48, Bravo. 49, Alpha. 50, Charlie. 51, Bravo. 52, Charlie. 53, Delta. 54, Bravo. 55, Charlie. Any questions on problem set?
Oh,
51 was Bravo?
so
51 was Bravo. Anything else?
I can't wrap my head around number 35 for some reason.
35?
Yeah.
Let us read 35. If there are 1.5 million fully diluted number of shares presently outstanding for Colin, this number includes all of the shares from all options that are presently vested and are in the money. Read, Colin W. Hampton has issued a total of 250,000 options on its shares in the form of stock options to its CEO, Durham. Each option is exercisable into 1 share of REIT. Of the total options issued, about 100,000 options are vested and are also presently in the money. What is the total number of basic shares outstanding? What's the confusion?
So is it 1.5 million are diluted, and that includes the 250,000 that are options? So like my brain keeps on telling me that it's not even an answer on here, so that's confusion. But my brain keeps on telling me if there's 1.5 million diluted shares, basic shares should be 1.5 minus the 0.25, 250,000 options, plus the 100,000, but that's wrong.
Colin, how did you solve it?
I think I took the 1.5 million outstanding, and then there's only 100,000 options that are in the money, so those are the ones that are going to be exercised. So then I subtracted that from 1.5 million, and then you get 1.4.
The 250,000 is misleading. So you have 1.5 million fully diluted shares outstanding, right? That includes all of the options that are presently vested and are in the money. And then it tells you 100,000 are vested and presently in the money. So of the 1.5 million, 100,000 is the options, and the 1.4 million is the basic number of shares.
And the basic number of shares includes unvested options?
No, doesn't include anything. Ah. No, it only says, it doesn't talk about unvested options. This number includes all of the shares from all options that are presently vested and are in the money. So this number includes the 100,000.
The 1.4 does.
Yeah, 1.4 does. The other 150 don't count in the basic. Options are not counted as part of the basic.
That's why I keep on getting the 1.35, but I'm wrong, I guess.
But does that make sense? Or is it still confusing?
It's still a little confusing, but
So
I understand like the definition of the two.
Yeah. So 250, just keep the 250 out of there because it is 250. REIT has issued a total of 250,000 options on its shares in the form of stock options to its CEO. Each option is exercisable into 1 REIT share. Of the total options issued, about 100,000 are vested and also present in the money. So total number of fully diluted shares is 1.5 million, of which 100,000 are coming from options. The remaining 1.4 is basic. Anything else? So everyone did well on the midterm, right? Did it take anybody more than 4 hours to finish the midterm? Maybe. What do you mean maybe?
I don't remember, but it was challenging.
Well, if it was not challenging, it like would not be fun, no?
Right.
All right. Do you have your midterm? Let's go over the questions. Let's list the question numbers, and then we'll go question numbers, concepts, anything.
Can you do the whole thing?
Why?
Because I'd rather just go over and follow it. I did it.
Was it that bad?
No.
Or did you just
I
flip a
still have-
coin?
What?
Flip a coin twice.
No, I have my question.
If it is if it is heads, then I choose A or B. If it's tails, I choose C and D. And the second toss of coin is?
I can just ask them when I'm wrong about that, I guess. So next time.
Well.
I
Let's go
have
through.
my question.
No, there's obviously there are conceptual things you have, questions, so let's go through all of them. Yes, let's go through this. Question number? 15. Questions that you would like me to clarify.
Number.
28,
18.
18,
6.
6. Fourteen.
27.
27. Mr. Miller, what happened to your hair? Got a haircut.
Oh, you cut it for me, but then.
He cut it for you?
I did. Yeah.
Why?
What? What do you mean why? Like, because I just wanted to cut it short, and then he said, I'll
Is
just
he a
do it for you."
specialist or why did you go to him?
Yeah, he can do it for you next time.
All right. What else? Weston? We are going through any questions you want to clarify on the midterm.
Okay.
36.
37.
37. 43. 42. 25. 30.
21.
You have your midterm with you?
There's no like solution key to the midterm yet.
Sorry?
There's no solution key to the midterm yet.
Not yet.
It's like.
You
how
can
we know?
submit your midterm exam by tomorrow. Resubmit after this recitation.
Okay.
And then final grades of that will be graded, and those will be your final grades. And next class I will give you the key, right? The
Alright.
correct answer.
Gotcha.
Anything else?
44, 45.
Yes, what else?
$13.
13.
I got a question, just about like doing the corrections. Like, so what if we got it right the first time and then we
get it wrong,
Yeah.
then the wrong will be correct, will be the counted towards the grade.
Okay.
So if you got everything right, tomorrow's submission is the final submission. Okay. Otherwise it would be just too lenient. No.
And 17?
17. Alejandro, is it okay?
They're covered.
They're covered. Patricia? Max?
Mine too.
Sorry?
Yeah, mine are there too.
You what?
Yeah, mine are covered there too.
Okay. Mr. Durr?
Yeah, same.
Carter, all good? Sean? Jordan? Yeah? Gabby, anything else? You wanted to do the whole exam?
Yeah, well,
So just go through it. What else you want to
these
do?
are the ones that stood out to me.
Okay. Do you have any idea which ones you got right?
Some of them, yeah, like, I think so, but
These are more,
these are the ones
then you
that
got
stood
wrong.
out, yeah.
right?
I don't know, maybe I got them right, and then I'm gonna change it and
They'll
I'll
lose
get
some
the later
points.
on, yeah.
That's why it's about understanding, right? Less about grades, more about understanding. That is the beauty of this, right? When you do this, tomorrow if you submit it, if you did not understand the first time, you'll probably call in strategy, call it, well, beware, call it. All right. Okay, let's go by one, and if you have any others, we can add. Number 6. Who asked 6? Gary. If the covariance between stock A and stock B is 100, standard deviation of the stock A is 10%, and the standard and that of stock B is 20%, calculate the correlation coefficient between two securities. What was your issue with this?
Well, I did it, but I just don't know if it's correct. I divided the covariance by, stock A times stock B's percentage.
Standard deviation of each, yes,
Yeah.
but you use the percent.
Yeah, like as a decimal. 21 times.
Yeah, I think you have to use 10 and 20 rather than 0.1 or 0.2. In these calculations, you have to use the absolute number. Okay? So correlation is the covariance divided by the standard deviation of A and standard deviation of B. So that was number 6. Number 13. Is that okay, Gabby? 6 is okay?
Yeah.
Number 13. If an investor in a 10-year US, who asked this question? 13.
I did.
If an investor invests in a 10-year Treasury inflation protected bond with an expected yield of 1.8%, she expects this yield to compensate her for real interest rate, expected inflation, neither A and B above. Actually, it should say neither A nor B above. Both A and B above. Now, what was the confusion?
So, I'd like to understand, like, what would protecting against the real interest rate look like?
Sure. So when you buy a US Treasury inflation protected security, you are compensated for the real rate, which would be, you would be compensated for in any case, plus you would be compensated for the inflation. Right? If you buy a nominal security, you're not being compensated for the inflation, only for the real rate. Now, the confusion could be that, let's say, 10-year inflation protected, right? So this goes to the heart of how inflation protected securities are. So inflation protected securities, the way they work is, let us say you have a face value of 1,000, right? And an interest rate of 4%. This is I, and this is inflation, the real rate. Inflation is, let's say, or maybe make this inflation. R is equal to 8%, coupon, right? Coupon, 8%. So, what would be the coupon here? $80, right? Or maybe let's say time period, amount. Period, let's say it's a 2-year bond. So period 1 or half a period, first half. I'm going to explain what I'm doing here, 1 second. 1,000, 40, 1.5, 1,000, 40, 2.0, 1,000, 40. Okay? That is the coupon. Now, how much would you expect to receive at the end of the first half of the year? You invest in a treasury bond, which is a nominal treasury bond with a face value of 1,000. Is anything not clear about this? So raise it and I will explain, right? So when you buy a treasury bond, and we will start with the bond shortly, you buy something which will give you $1,000 at the end of the 2-year period, if it's a 2-year bond, right? So this is the face value of the bond. So after the first half year, you will get 8% coupon. So 8% in a half year is 4%, which is $40, right? So what will be your cash flow? Cash flow would be 40 here in the second half, third half 40, fourth half 40, plus here you will get back your face value, right? And so you have to pay for this set of cash flows. What you believe is the value of this cash flows should be the present value is how much you will pay for the bond. And I'll discuss more of this in detail later. Now, if this was a TIPS, what will happen? Right here, in this case, you're not being compensated for inflation. If you were to be compensated for inflation, so what will this look like? Start with 1,000 first half year, or maybe at year 0, you 1,000. So this would be 1,000 times 1 plus 2%, right? Yes, no? You increase the face value by the inflation. Full year inflation is 4%, half year inflation is 2%, right? So what happens is you started with by buying this bond by paying something, and the face value at the end of the first 6 months is 1,000. Face value increases by the inflation amount. So the coupon you get on this is what? Is 4% times 1,000 times 1 plus 2%, which is what? 40 times 1.2. How much is that? 4.8. So you get $48. Okay? Now what happens? Here, this face value grows by another 2%, compensate you for inflation. So it becomes 1,000 times 1 plus 2% to the power 2. Right? And therefore, what would be the coupon that would be paid here? 4% of this amount, which will be what? Who can do the math? 4% times 1000, this is 40 times 1 plus 2% to the power 2. How much is this? Augusta, you running the Excel?
Gotcha.
1.2 to the power 2 is what?
The first one should be 4080.
What?
No, 4080.
Yeah.
Yeah.
I was gonna say it
Yeah.
went down 41.
It should be
40.
4080.
This should be 4080?
4080.
Yeah.
Ah, yes, yes, yes.
41.
And the second one is 41.
41.6.
Yeah.
And what about do it 3 times? So this would be 1000 times 1 plus 2% to the power 3, 1000 into 1 plus 2% to the power 4, right? And so 4% of that. What is this and what is this?
42.4.
42.4?
Yeah.
And this?
40. Yeah.
43.3?
Yeah.
Plus 1000 you get back here. So this is your set of cash flows now, right? By increasing the face value of the bond by the inflation amount, you are getting compensated for the inflation, right? Because now the coupon is also higher. That makes sense? So this was 13.
Could you repeat that one more time? You said
What?
repeat that.
By increasing the face value of the bond or indexing it or linking it to inflation rate, you're increasing the face value of the bond. And because of that, because your coupon is linked to the face value of the bond, your coupon also increases. So because everything is now increasing by inflation, you are, to the extent there is a loss of value of money because of inflation, you are the base money is increasing, so you're getting paid more to compensate you for inflation. Yes, Weston?
When you buy a bond, are you not buying it for the face value?
When we get to the bond shortly, let's discuss that. Okay? The answer is no, not necessarily. Except in certain specific conditions. Alright. That is 13. 14. Who asked 14? Gabby. A reasonable market. I'm going to send you my invoice for this, for all these questions you're asking. A reasonable market risk premium based on long range data in the US equity market has been what?
I don't know what it is.
No, we discussed
Should
it
I
in the
Google
class.
it?
No, you don't have to Google it. Let me ask someone else. How many of you answered A? How many of you answered B? How many of you answered C? How many of you answered D? So 1% answered C and B answered, right? So most of the class answered B. Follow the wisdom of the crowds or follow the person who walks alone, huh? Or just ignore any company, right? So the answer is 4 to 8% is reasonable. Right. Number 14 we did. 17. Who asked 17? Arthur. If a firm uses the same company cost of capital for evaluating all projects, which of the following is likely? Rejecting good low-risk projects, accepting poor high-risk projects, correctly accept projects with average risk of the company. Which one is correct of the two? What was your confusion about?
The third one was confusing to me.
Correctly accept projects with the average risk of the company. Why was it confusing? What was confusing about it?
It was just the wording was kinda odd.
Oh. Okay. Anybody who wants to explain to Carter how you thought about it? Max?
I could, I don't think you're gonna like my explanation. I don't know, I thought, I thought 3 was, right. And since there was only one option with that listed, I went with that.
No, conceptually you have to explain. I don't know which is right, which is wrong.
Well, I mean, I mean, if you're using it, if you use the same WACC, cost of capital for all projects, you're going to accept projects with the average risk of the company. I think.
Question?
So if a project is high risk and the average cost of capital is lower, then your underwriting is not conservative enough, so you might accept 4 high risk projects, and on the other hand, like, same thing applies vice versa. And also it could happen that the project risk is similar to the company risk, so then you're correctly accepting projects with the average risk of the company also.
All right. Thank you, Wes. 17. 18. Who asked 18? Max. The market value of XYZ Corp's common stock is 50 million. And the market value of its debt is 50 million. The beta of the company's common stock is 1.3 and the expected market risk premium is 8.5%. If the treasury bill rate is 2.9%, the cost of XYZ's debt is 6.5%, and the marginal tax rate is 21%. What is XYZ's weighted average cost of capital? What was the struggle here?
So is the treasury bill rate its cost of equity?
Treasury bill rate is the cost of equity?
No, so how do you come to cost of equity? I kind of forget why, but I found this question confusing.
Yeah, well, let's go through it. What? You were saying?
Me?
Yeah.
Nothing?
Expected return on equity is equal to the risk-free rate plus beta times market risk premium.
Yeah, I know, because I tried to find, that's.
Find what?
I couldn't figure out what the cost of equity was either, and I used that.
You use this?
Yes.
But we went through it so many times.
Really?
Yeah, you're probably in Israel.
No, that was after.
Meant to be, I mean. So risk-free rate is
2.9.
2.9%. Beta is 1.3. Market risk premium is?
8.5.
The whole thing is
Yeah.
8.5, right?
Yeah.
So this should give you the cost of equity. How much is the cost of debt? 6. Cost of debt, 6.5%. And how much is this actually?
13.95.
Okay. So what is the cost of capital? Weighted average cost of capital is equal to cost of debt times debt by value times 1 minus t plus cost of equity times equity by V. Right, Max, is that okay? So we know debt is 50%, equity is 50%. So 6.5% times 50% times 1 minus 21%. plus 13.95% times 50%. Yeah? Can you solve it now? Next question. This was 18. 18. 21. Who asked 21?
I have like I was deciding between C and D, and I think it's, I'm not sure. I don't know, like, I want to know if you could explain why.
Good idea. Otherwise, it would just be a toss of the coin between C and D.
Well, I think, I always thought that zero coupon bonds would, they'll make like least risky, but I don't know why.
Good question. What about others? How did you think about it? How many of you answered A for that question, 21? How many of you answered B? How many of you answered C? How many of you answered D? Those who answered C, what was your reasoning?
That's just what I thought was kind of standard to use as risk-free.
Same US Treasury.
Yeah.
Okay. And how many of you, Colin and Weston, you did D? What was your reasoning?
I like that it was a tips, so I've got inflation protection, and I don't have to worry about intermediate like cash flow risk. So that's why I went with the zero coupon.
Yes. Yes. When we think about this risk-free rate, what does risk-free rate mean? It should be risk-free. So you have to figure out what is that security which is risk-free. In order to think about what is risk-free, you have to see what are the risks in the security. What is it that makes it risk-free? What are the risks with what are the risks with any security, which if they're eliminated, it becomes a risk-free security? One is, this is a government bond, One is the default risk, right? The government will default because and now if it was the Argentinian government or the Russian government, I can imagine it will default. But this is the United States government, right? It's not going to default. Big country governments are not going to default if they print their own money. Chinese government will not default. Indian government will not default. British government will not default. Germans will not default. Okay? So, default risk, it's a US Treasury, that doesn't exist. What other risks? Inflation risk, right? You saw the difference here? Here you are compensated for inflation, here you are not. This is a TIPS. A TIPS compensates you for inflation, so there has to be a TIPS element to that. And the third risk is reinvestment risk. When you buy a stream of cash flows, the cash flows have to be reinvested. Let's say you buy a stream of cash flows and your expected return is 10%. What does that mean? That means the cash flows you get have to be reinvested at 10%. Otherwise, you will not get the 10% return. If you cannot reinvest at 10%, you can only reinvest at, let's say, 2%. Your actual return is going to be less than 10%, right? You remember IRR? IRR? Let's say, what is IRR? Minus I plus cash flow 1 divided by 1 plus R to the power 1, cash flow 2, 1 plus R to the power 2, plus cash flow 3, 1 plus R to the power 3. Let's say 3-year cash flows. What is R here? If I give you I, CF, 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 all the cash flows, can you calculate R? Yes, no?
Yes.
How? How will you calculate R?
Set it to 0, and you'd have to do a.
IRR.
It'd be hard for polynomial, but you could
Yeah,
solve
that's
for it.
exactly right. It's a polynomial, so you can't solve it with your mental math. You have to use Excel. And this is exactly what IRR is. IRR, select the cash flows, range of cash flows, and guess. And it will give you this number, R. Okay? So, why is it called IRR? What does IRR stand for?
Internal rate of return.
Internal rate of return. Rate of return we know. What is internal? What does the word internal stand for?
Within.
Of course.
With the discount rate that, use the discount rate.
The cash flows associated with whatever you're calculating.
Internal means the money stays inside the system. It doesn't go away. Right? So the cash flow you get here, it gets reinvested over one period and the second period. And it gets reinvested at R, at your internal rate of return. So there is this reinvestment element to any security you buy. To the extent there is reinvestment, there is a reinvestment risk. Let us say your IRR is 10% for this investment. This means that this cash flow one that you're receiving, it will be in the system, and therefore as the system moves forward, this will get reinvested here at 10% and another 10% here. This one gets reinvested at 10% here, right? So what if you practically, this 10% implied reinvestment is a mathematical number. But practically, what if you receive your cash flow one and you cannot reinvest at 10%? How can you reinvest? You can only reinvest at 2%. Your IRR becomes incorrect, right? There is a reinvestment risk. You thought based on your IRR calculation you will be able to get 10% return. But you really cannot reinvest at 10% because you don't have the opportunities to get 10% return from. You can only get perhaps 2% or less, right? So you're expected a 10% return during the holding period, annual return during the holding period, but you only get something less than that. That is called reinvestment risk. Okay? How do you mitigate reinvestment risk? You find a security where there is no potential for reinvestment. And what is that security which has no potential for reinvestment?
Zero coupon.
A zero coupon bond. A zero coupon bond is something you pay a certain price here, 3 years down the road, you get some face value here. That's it. There is no coupon coming, no cash flow coming in the interim periods. That's why there is no reinvestment risk. That's why the correct answer should include some element of tips and some element of zero coupon bond. Yes?
So then why does the industry use?
That's a wonderful
That's
question.
kind of a backwards question.
No, it's a great question.
No, like this was a backwards question. Because like people use like appropriate, I guess, versus what's normally used.
Why do
And what
people
everyone
use?
thinks is appropriate.
Let me counterpose the question to you. Why do you think it is that way?
It's easily available.
Yes, but we live in Wall Street world, everything is easily available. They can construct a zero coupon tips.
Most liquid, like security versus a zero coupon tip.
Yeah, the reason is our inflation has been very less, insignificant. That's one reason. The other is because these are short term, typically risk-free investments are short term. So there is no really reinvestment risk. It gets rolled over. So it's a good proxy. It works in a proxy where inflation is less than 2%, 2%. But if inflation were 12%, 13%, 14%, that's where you will have to use the answer 4. Make sense? Yes, no? You seem skeptical. Yes, sir.
No, I conceptually understand, I just think that.
Practically. Yeah, practically, because inflation has been low.
Practically, the answer
If
is
you are an
yes.
investor, if I am an investor, in a low interest rate environment, I'll be fine with this. But if I see 14, 15, 16, which you see in many different other markets in the world, I can't use it. And even if I do, I have to adjust for inflation. You can adjust for inflation, and you can keep the rollover. This will be very frequent. Short rollovers. Number 21. This was 21. Any questions on 21? Any other? Gabby, is that okay with you? Augusta, is that okay with you too? 25. Who asked 25? Probably did. We forgot.
Well, I'm sure I did, or I was thinking it at least. My question with it was.
Let me read the question first. The risk in an investment will always be perceived to be higher for an undiversified investor relative to a well-diversified investor because. Okay, what was your concern with this question?
So I read, I think the textbook that diversifying your investment eliminates specific risk, but I don't know what that means. So I still, like, I chose that as my answer, but I don't get it. I chose A.
But that means nothing.
Yeah,
If
I
you don't read the
understand
reason
it.
behind it, that A, B, C, D means nothing. Okay, we discussed this in class, right? How many of you answered A? How many of you answered B? How many of you answered C? How many of you answered D? What? What did you answer?
A.
I'm looking at you guys and you're not even raising your hand. Patricia?
No, I thought yeah.
Max? How many of you answered A? Alright. Maybe we'll take 2 breaks in the class today because it's sleepy. Huh? It's looking outside so bright and beautiful. Why are we inside? Huh? Maybe I should dim the temperature, put some music on. My voice sounds lullaby-like anyway. Maybe that's how we should conduct the class today. How can you be tired? I woke up at what time? Guess?
4:30.
3:30. I'm still on China time. Okay? So I woke up at 3:30, had nothing to do. You know, some student sent me an email at 3 o'clock, somebody is worse than I am. And I replied back immediately.
We were probably going to sleep at that time.
Maybe after a long party. Yeah. Yes, sure.
I honestly like see a few of these options being somewhat correct. I mean, I put A, but I also somewhat see B. If you're well diversified, even though there's always market risk, like you're still like there.
Yeah, but that was the intention of the question, to have you clearly understand this, what it means. And we discussed it in the class. You remember how we came to CAPM, the whole logic of how we arrived, why CAPM works. We started with this. We started with the idea of diversification, right? 1 stock, extreme exposure. 2 stocks, slightly less exposure. So let us say number of securities, and let us say this is the sigma, this is the volatility. 1 stock, perhaps the stock is somewhere here. You add 1 more stock to your portfolio becomes here. You keep adding. Right? All these are stocks. What will happen is you will see something like this. Let us say you have a stock here and a stock here. Which one would you prefer to invest in? The one which has low, yes. My pencil right this maybe. It's not right here. Somewhere. So the one which has relatively lower volatility. Right? That's what you in. And so as you keep increasing the number of securities in your portfolio, what happens? The specific risk of the firm gets reduced. Someone outside?
There was
Who was it?
an older man.
Huh?
An older man. Like,
How old?
like 50 to 60.
50 to 60 is an older man?
Like, I mean, not as, not
You don't realize you're more funny than I think. So what happens as you increase the number of securities in this portfolio, increase in number of securities, the risk goes down. That is the concept behind diversification. You can keep diversifying, keep adding more securities. There will come a point where this curve, it becomes parallel to this. If you increase the number of securities, nothing happens. You still have this risk, this. This is called the market risk. Or undiversifiable risk. Or what else is it called? Systematic risk. Systematic risk. It is related to the system. Let us say you have a company that produces umbrellas and you have another company that produces sunscreen. As you combine companies which have different, correlations are negative with respect to each other, you will benefit from diversification, right? So as you increase this, there is a floor below which you cannot reduce any more risk. What is left is called the market risk. You cannot diversify. This is the risk related to interest rate changes, things beyond your control. But these you can control. The firm related things you can control as the management, or have the management control if you are the owner of the company. Okay? So now the question is, for an investor who is completely diversified, what do they care about? They really don't care about would you care about the firm specific risk? No, because you can take on, all is left with your market risk because you already have diversified away your firm specific risk. You don't care about it. Let's look at B. For the well-diversified investor, market risk does not matter. Market risk matters. Market risk matters. Right? In CAPM, risk-free rate, expected return, is equal to risk-free rate plus beta times market risk premium. What is this? Is what?
the cost of equity.
Cost of equity, yes, cost of equity. And cost of equity here is the beta, right? So this beta measures your covariance of your stock relative to the market, right? So all that matters is how your stock varies with respect to the market. If you are a fully diversified investor. If you were not a fully diversified investor, then aside from this, something else could matter also. Because then you would be concerned about reducing of your firm specific risk. You could add more securities to reduce this. So this idea of capital asset pricing model is predicated on the fact that you already have a fully diversified portfolio. So market risk is the only risk that matters. Firm specific risk does not matter. Okay, because you have diversified it. Third, for the undiversified investor, firm's specific risk does not matter. For the undiversified investor, everything matters. So C and D are out. Does that make sense? Gabby? You remember this for the rest of your life? Yeah, you better. So 25. The next one is 27. A company expects to pay 100 million every year in interest forever on its debt. If the company's effective tax rate is 21% and the weighted average cost of capital is 10%, what is the present value of this perpetual interest tax shield? Who asked this question?
I think I may
Okay.
have. I just don't recall talking much about tax shields. Just wanted to know.
We discussed tax shield in real estate finance.
Yeah. Just give a refresher.
Yeah, we discussed it here also. I think it was in problem set 1. Okay, what is a tax shield? Let's think about it. Let's say in this case, you are paying 100 million every year in interest. So you can deduct that interest every year, 100 million from your income to get to your taxable income, right? So the benefit you are getting every year is the deductibility of that 100 million. Because your tax rate is what? 21%. Of the 100 million, your actual cash benefit is only 21% of the 100 million, right? But that is per year, every year. Now, the question is, it's asking what is the present value of the perpetual tax shield? Because if you were to own this company forever, which gave you 100 million of interest deduction every year, what is the forever benefit of that 100 million deduction every year? So you have your annual deduction, which is 100 million times 21%, which is 21 million per year, and the value for perpetuity is
Goes on forever.
cash flow divided by R. So the 21 million divided by the 10%. Okay. Any other questions on 27? 27 is done. And then we have 28. Who has 28? Shyam?
I think I did, yeah. So I got the answer, but I think A, which I think is correct.
We're talking about 28, right?
Right.
Yeah. What is a real option? Real options are valuable because they account for. We had a brief discussion on this in the class. You remember? Everyone remembers? Yes, no?
You can buy options to take account of risk of their share price. So I guess the question is really just like, what does real options mean in this? Just said it.
We
Context.
saw when we did CITIC Tower 2 that we put a value on the investment which was based on a discounted cash flow. You discounted the cash flows by a discount rate to get to the value. And this is what you have done so far everywhere, all your classes so far. Is there a problem with that analysis? The answer is yes. What is the problem? The problem is when you do a discounted cash flow, you assume today when you are underwriting your investment that your cash flows will turn out to be exactly how you underwrote the investment. And you have an assessment of your average risk during the holding period, which is your discount rate, and that's what you use to discount it and get to a value of the investment. If your net present value is 0 or greater than 1, then you invest, otherwise you don't invest. What is the problem with this? The problem is when you are actually managing a project, you really don't make the decision today and just observe everything that happens passively after that. What you do is practically, you make a decision today, and then perhaps if things change, you make a different decision, and you keep changing your decisions. So the way your decision process unfolds is not linear or not preset. You have flexibility. So the real option process allows you to incorporate managerial flexibility in your decision making. That's why it's called a remote. Okay? So that is 28. $30. Let me read this, and who has 30? Default.
I don't know.
30. Let's read 30. But do you still want to answer that? Just look at it.
I think I got it, but if you wanna go over them.
No. You have to tell me if I don't want to go over any question at all.
Okay. Actually, yeah, so, well, you can read it and I'll ask you.
The financial statement of REIT XYZ show should be either financial statements or shows that 2.5 million common shares authorized. The financial statements of REIT XYZ show that 2.5 million common shares are authorized and issued, and 250,000 operating partnership units. Each operating partnership unit is exchangeable into one share of a REIT XYZ. No options are outstanding or issued, and the share price of REIT XYZ is $10. What is the fully diluted market value of REIT XYZ?
So what I wanted to know is like the fully diluted market value, would that include all of the 2.5 million common shares? Because that's what I thought. Like,
Yes, those are the basic shares, right? The 2.5 million are the basic shares, authorized and issued, and 250,000 operating partnership units. These are the ones that have not been converted into shares, but they will be converted into shares. So total number of shares, fully diluted shares outstanding, is the sum of the two. Okay?
If you're making grammar changes, I don't think that you should have that in there.
Tell me, what should be the right grammar?
It says the financial statements show that then it just says shares and other shares.
I'm saying common shares are authorized and issued.
Yeah, you have to say are
Yeah.
authorized,
And
and that
250
there are, or you can just get rid of that.
Yeah. Thank you. All right. That was 30. 36. Who has 36? Would that be you, Gabby?
could be me.
At 36.
I don't think so.
Shyam, you asked that?
Yeah.
Okay, let's read it and then you tell us why. In the legal organization structure of a REIT that finances itself with debt, both mortgage debt and unsecured bonds, and equity, at which entity level are you most likely to place the mortgage debt and the unsecured bonds? We went through a org structure of a REIT when we discussed A and B. Do you remember? Yes, no? Kind of. So what happens is, if you look at a REIT structure, this is the REIT. When you see a rectangle, it means an incorporated company, corporation. When you see a triangle, is a partnership. We saw this property were contributed, right? so on and so forth. And here, and here, here. Shareholders and shareholders. Dollars. Okay. So this is the REIT structure. Most of the properties are held in their own entities, and they are part of the operating partnership if it's a REIT. And this is the corporate structure. The shareholders are here at the incorporated level, the corporate level. The question is, if you wanted to place new mortgage debt and unsecured bonds, where would you do it? Where would you place it?
I would think for the debt it'd be at the property level because they're individual.
The mortgage debt would be here because the bank wants to collateralize its, or wants a collateral.
Right.
And they want to be as close to the property as possible, right? And you also want them to be as close at the property. You don't want them to be here because if they are here, then everything is collateralized, right? You only want to give as collateral that asset against which you have borrowed from the bank.
Yeah.
So you want to isolate that borrowing. So that's where this would be mortgage debt. Unsecured debt, on the other hand, is typically where?
At the entity level?
At the entity level. Why? Because unsecured bondholders get paid after the debt service to these property, the mortgage debt holders are getting paid. After they are paid, whatever cash remains, it goes to the entity level. So if you are an unsecured lender, you want to lend at a level where you have access to all the cash flow that is being generated from all the properties, which is over and above all the mortgage debt payment that you have to make. Okay, that's why. Does that make sense? So that was number 36. 37. Who asked 37? Gabby, very happy. Raise your hand. 37? Yeah. Let me read it. You tell me what your confusion is. Relative to an industrial company, for a REIT, the metrics that most closely approximate free cash flows and the earnings of the business are. Who's going to answer this question and help Gabby?
B.
Logic, no. I don't know what the answer is. I can't say yes or A or B. What's the logic?
Okay, I went with B because FFO, in terms of earnings, it has net income, but then we add back depreciation and amortization, and we either add or subtract gains or losses on sales. And then adjusted FFO accounts for our CapEx and our like losses or gains on land, and that kind of gives you back your free cash flow because you have to spend on CapEx, and then you get back the money on gains or losses on land.
Free cash flow is an idea that is used on Wall Street to look at the pure cash that flows to the equity holders from a company. Free cash flow. What is the closest approximation of free cash flow for REITs? AFFO, right? We saw, because we made all the adjustment for non-cash items to bring it as close to cash. Now, earnings of a business is net income. What is the closest approximation of net income for a REIT based on the NAREIT definition that we had? NAREIT made an adjustment to the net income of a REIT and that adjustment was to add back the depreciation, right? Because REITs have depreciation, which is a non-cash expense. If you take the net income of a REIT with depreciation already embedded in it, which is basically you've taken out the depreciation, then your net income looks very less compared to an industrial company. So you are at a disadvantage. Investors will not invest with you because they're looking at net income. In order to do that, they made the adjustment, and they had an adjustment whereby they defined what another metric should be, and that metric was FFO. FFO adjusts for, it adds back the depreciation. the major non-cash expense that a REIT has. And they say FFO is equivalent to the earnings of a company, earnings of a REIT. Is that okay? Was that your question, Gabby? Did you ask that, 37? All right, are you okay with that? Satisfied? 42, who asked 42? Who asked 42?
I'm curious to know the other way.
Sure, let's read it. REIT XYZ's dividends are expected to grow 5% per year, as far as one can see into the future, and its present dividend yield is 5%. If REIT XYZ stock is expected to keep pace with the growth in dividends, the expected return, market return on REIT XYZ stock is what? What was your confusion?
I wasn't sure, I think, exactly how to go about this. I came to an answer, but I'm not sure if I'm right.
So how did you come to the answer? Forgot?
Off the top of my head.
Okay. Well, the thing to remember is, any investment, the total return is always equal to your income return plus your capital appreciation. What is the dividend? What is the equivalent of an income return for a REIT? Dividends that the REIT pays out. Right? The dividend yield is equivalent of a income return. What is the proxy for growth for a REIT? The capital appreciation. So if you add those two together, you will get to the total return. That was 42. Max, is that okay with you? Yes, Weston?
Like it's 5% on both, like your yield, your dividend yield, and like the growth of the stock. So would your total return be if it's 5% times one of them plus 5% times the other, wouldn't it be like 5% times the sum of both? Like your return would still be 5%?
I don't understand. Why it would be 5%? What is your income return? What's the proxy for income return?
Dividends?
Dividends.
No, yeah, no, that's 5%.
That's
and-
5%.
And the stock growth is 5%.
Stock growth is 5%. So what's your total return?
I would think 5%.
Why?
Because if you're doing 5% times one number plus 5% times another number, that's the same as doing 5% times
No. Why? What is the other number?
the stock growth.
No. Not for dividend yield.
No.
Dividend yield is the dividend amount divided by the share price. Dividend per share divided by the share price. So that is your income yield. What is your capital appreciation? The delta between the share price over 2 time periods. And if the 2 time period is 1 year on the average, so that you have to add the two.
Yeah.
This is the big, if you want to learn one thing in finance, right? Everything is all silly theory. This is the equation you got to always remember. Expected return is equal to income return plus capital appreciation. The moment you forget this equation, chances are you will be poor. But if you remember this equation, chances are you will be wealthy. Because you will have the first line of defense, income return. You want to have some income return to compensate you for inflation. Because all capital appreciation would come, may not come. It's all blue sky until you actually get it.
How about using a dividend discount model? Is that overcomplicating it, or
In this
well, like to solve for this?
dividend discount model,
Yeah. You don't tell us the value of the stock, so I just made
no
it
dividend
one.
discount. See, if the theory is this, the dividend discount model is the dividend you receive. If the company pays out everything, right? all the cash that a company generates is pays out as dividends, then there is no growth in the company. Right? So the dividend is a perpetuity. You're receiving these dividends in perpetuity forever. What is your expected return? Gives you the value of the perpetuity. Right? You only add the growth when there is some retention of some money in the company, because that money is getting reinvested into something which is going to create growth.
The expected return, are we saying that's the same as our discount rate?
Yes. Yes. In the discount rate adjusts for the risk of the investment that you're making. And if you are taking more risk, your expected return will be higher. So they are intertwined, those concepts. All right, so this is 43, right? No, that was 42.
Yeah.
Let's do 43. Who has 43?
I
Jordan?
asked my help with that because I did the formula like risky rate plus beta times the market risk premium, and that answer just wasn't an option.
If the average annual return for REITCO for common stock is 15%, the beta of the REITCO stock is 2 times, and the US Treasury bond yield is 3%, what is the implied market return? Average annual return.
So that's the expected return.
Yes, and the beta is 2.
Backwards.
What is the implied market return? Yeah. So it's asking you, you are given this, 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 and this. So you have to calculate what this is. Right? What is the return on market? $44. Who asked 44? Nobody did, so we can move on.
I was confused. Do you include the dividend?
Let me read it. REIT XYZ share price at the end of the last year was 55. At the end of this year, the price is 65. During this year, REIT XYZ paid total cash dividends worth $5 per share. What is its annual year-on-year total return? Total return always includes the income return. That formula, right?
Yeah.
You're okay?
Yep.
That was 44. Last but not the least, 45. Who had an issue with 45? Who raised 45? If not, we can move on. Shyam?
Yeah.
Okay. On a certain parcel of land, a REIT's management wants to build a project worth 3 million today, for a construction cost of 2.6 million. However, if they wait for 1 year and do not build the project until next year, the project would most likely be worth 3.5 million. And the construction cost would be 2.7 million. If the REIT's investors require a 25% expected return for holding land, what is the value of the land today? Should you build the project today or wait until next year? Who solved this question? Who thought they solved this question? Colin, why don't you explain to Shyam?
So I took today's numbers, 3 million, and then the cost, subtracted those and came to a profit. And then I took the numbers for 1 year forward, the revenue and the cost, and I discounted them by the expected return for holding the land, and then came to another profit number.
Shyam, does it make sense?
Yeah.
So, if your present value of waiting is greater than the present value of what the outcome is going to be today, then you would wait. Right? And vice versa. So should we move on then? Is that okay, or do you want me to explain more?
So you take the higher option for present value.
Yes. If your present value of waiting is greater than present value of getting what you're getting today, then you would wait. Otherwise, you would not. All right. So let us take a 10-minute break. Okay? And then we come back briefly. By the way, I wanted to ask you that in the class on next Monday, can we start the class at 1 and end at 4? The usual time? Yeah? Okay, so I'm not made a final decision on this. I will send you an email. They want me to be on a panel discussion somewhere, so I want to help them out. If that is the case, the panel discussion goes from 4 to 5. So I probably finish the class at 4, but I'll let you know to confirm.
Is the panel discussion here?
Somewhere here in this. Although I'm a bad panelist.
What's the panel on?
I have no idea. They haven't told me.
Oh, really?
It's for like the new students who are coming in. So they want to introduce them to a scary professor. Yeah. That's it. I announced the date when the problem set 2 is due, right? In the email I did.
Oh.
We got like durations and volatility. I actually don't have.
Yeah, we'll do all that. We'll start, not today, but maybe next class. We'll not be able to get to that point. Why, you want to do duration volatility today?
I would, that's actually, yeah.
Why?
Just because I don't know.
You just said that it'll be handed out so we can complete it over the next few weeks.
Yes, that's what I said.
Yeah.
I'll give you a specific date, actually. I think I have a specific.
Yeah, but he's a little.
If you had to do, you discounted at 25%.
You did. 25% for that. One, but you didn't.
You discounted at 25%.
What's the period on the period duration? One.
It's 1 year.
What? I'm doing that.
What are you doing?
We're using it.
No, I use like, actually, I can do it. It's, cause it's just, 800 divided by 1 plus 2E. It's 60.
But
That happened.
有些地方没见，其实差不多。
So
Like
it's
the
so
book,
you do-
number 14, says C is the right answer.
So it would be,
Risk premium
You don't need to sell it.
Market risk premium
Thing.
for equity.
yeah, but so it's don't develop
Is what?
today, but
What
develop
rate?
it next year.
I
Should
don't
be-
understand
The book
why
says
you would
that.
just
What
They
does it
say
say?
8 to 12.
Cause it's,
8 to
the
12?
present value of the future money is greater than the.
Market risk premium changes also, that's for sure, but 8 to 12% is very high.
So you can-
B. Today, no, 'cause it's
I'd
rate,
say-
it's-
What's that?
I'd say-
I don't know.
Because in the book he goes through like bonds, equities, like something else. From like 1900 to 2016.
Sir, we didn't go over it, but for AFFO, do you add or subtract when there's a loss on sale of land?
Say that again?
For AFFO,
Yeah.
do you add or subtract when there's a loss on sale of land?
If there is a loss, that means it was taken out. It was an accounting loss, so you have to add it back.
You add it back.
You have to do the reverse.
Yeah. Okay.
what is it?
Yeah. That's what
$798 when I went, Mr. Yu, $798.
Oh, so it would be-
Yeah, it's a
Very
artist,
Right.
singer.
Yeah, it was like industrial
Yeah.
sheds where it converted into.
Yeah,
Yeah,
I
so
know
what-
it's a so now it's a artist
Yeah,
that's
so-
in her, but in a long time ago it's a machine factory.
What factory?
I don't know, watch or
Yeah, watch factory and lot of other things, leather and all that stuff.
yeah.
So, and actually we went into a restaurant where I saw
25 times
a
worth.
picture of Deng Xiaoping visiting that area back from the 83s.
How many points there?
And I had hired in Beijing, I hired a translator.
Oh, it's a very large factory. And I remember there is a old tree in the center of the park.
Yes, and you know where I went also?
Uh-huh.
I went to the bird nest,
Very nice.
the stadium,
Oh.
The Olympic
the
Stadium.
Olympic stadium, the bird's nest and
Oh, yeah.
and the water cube.
Yeah.
And you know who I met? I met the guy who actually built it, designed it,
Like,
Oh, really?
the
The
structural
German guy?
engineer, the structural engineer.
Oh.
So, I'm going to be teaching about it in my advanced class.
Does the advanced class cover more like development or is it?
It's a
finance?
combination. You guys design the class. You tell me what to do. I offer you 40, 50 topics to pick from depending on the majority decision in the class. And those topics are all very different. Everything is completely different. I believe they're very rich actually. All these courses are all foundational courses, but all this ties up into investing and thinking about development in that class.
How often do you go over like corporate finance transactions in that class then? Because I feel like most people here they like to stay at the property level.
In
you know,
that
they
class?
they love development. I just feel like most students are like that here.
Yeah, in the advanced class, we do take up a hostile REIT transaction. We can do more corporate finance transactions, but we do it more on an international basis. The thing with a lot of these concepts is if you discuss these concepts at the international level, then domestic level becomes a subset of it. What we start with in the program is from the domestic level. So that is an international class. So we have to treat most of the concepts we have already learned so far and place it in the international context, and then this concept becomes even more clear, deeply clearer actually. We'll probably have somebody who is the recent former head of RDA come and speak to us in the class. In the fall, sorry, the advanced class, yeah.
When do people, what's the, like, term do people normally take that class? Their
Sorry?
last, what term do people normally take that class?
It depends, they usually take it in the last, but one pre-final term
Right.
or along with the
Like
capstone.
before their capstone?
Before the capstone is ideal.
Mhm.
Some people take it during the capstone also. Those who take it before the capstone benefit more.
Right.
Before
Do
the
you have another,
capstone.
workshop, or what is it called? Loan workout?
In the fall?
Yeah.
Fall, we have a killer workshop coming up.
Really?
Yeah. That's part of, but that is part of the advanced class.
Yeah,
Yeah, weeks.
that was interesting.
Yeah, this one, the fall one is even more interesting
Why?
because we look at joint ventures,
Oh,
the negotiation of the contracts and the financial mechanics of joint ventures.
I wish that one we did was more like finance heavy versus legal.
This is going to be a combination of both. This is, I think, more finance heavy, but obviously legal is also important.
What is this workshop?
This is the MIT NYU workshop,
yeah.
Columbia workshop. So I have more latitude with the spring workshop. We invite more people.
Did you go up for the?
No, for the loan workshop we go up. And they come here for the second workshop in the spring.
Yeah, that's it. So the one in the fall you go up for.
No, we are here. They come here.
For
And we-
both?
Huh? No, in the fall we have one, but I'm thinking of adding one more workshop for
Oh.
which maybe they'll come here twice, or maybe we do it twice. One, we go there, they come here. Not yet decided. Poor Manish has only so much bandwidth, you know what I mean? But of all the workshops during the fall or the spring, the one in the fall is the best. Best in the sense intense, most intense learning experience. Did you go to that one?
No. But I'd like to involve.
Are you in the advanced class now? Are you? No. Tough one.
Did you do it in the spring?
I teach it in the spring
I
also.
only took 2 classes this semester, so I'm not, so I have more level 2 requirements to take.
Okay. Yeah, but you can take it even without.
You think so?
Yeah.
I'm taking classes that I don't have all the requirements for.
Yeah.
But you think I would get as much out of it?
Yeah, I think you have banking experience. Right, so you'll be fine. You should be fine. It's a lot of work though. That class, we had regular 14 sessions, and I offer like 22 sessions of that class. So you have to be here on weekends.
Oh, really?
Weekends is like, those are optional classes. But
Right.
let's say I offer 40, 50 options and students pick 20.
Right.
So, but we can only do 14 in the 14 set regular sessions. So other 6 or 7 or 8, we have to do in outside the regular session. So the way we do it is, if somebody cannot come during those extra sessions, then their preferred case discussions, we do it in the regular sessions. And we leave those for the rest for the weekends. So it's not going to be weekends, it's going to be either Friday or Sunday in the fall.
What, are there like, how is it graded?
It's graded on 2 projects.
Group or individual?
One is individual, one is team. One is a research project that can tell you. Are you doing the development track? Finance track. So, one is the research project, the other one is a fancy project. Very imaginative, creative project. was in China, I used to wake up at 3 o'clock in the morning. So I thought that I have a jet lag there. Then I came back here, I wake up at 3 o'clock. Crazy. I think my mind is averaging out my time.
When do you go to bed?
11. Let's get started. Okay. Who's missing? Weston is missing. Jordan is missing. Mr. Durr, are they outside?
Yeah.
So just call them.
What they could possibly do.
She was saying.
Okay. The rest of this class and all of next class, we will discuss this topic of corporate debt, bonds, and other fixed income securities. This is one of the most important topics. Most of your problem set 2 is based on this, and your final will be cumulative, include the first part of the course and the second part of the course, but will be slightly heavily weighted towards the second part of the course. Okay, so this is a very important segment of the course from an exam standpoint. Now, next class we will continue with this discussion, but in the class after that, we will do a case study, and the case study for which I gave you a list of questions, it's called AMB Consolidated, right? So when you go to the HBS website, don't be confused. There are a couple of AMB cases: AMB Financial Reporting, AMB Navigating Treacherous Waters. This is called AMB Consolidation. Okay, that's the case. Don't forget that. And in the class after that, we will discuss Travel Centers of America, which is a spin-off case. Fascinating case. And the class after that, we will do a recitation of problem set 2. We will use all that class section for recitation of problem set 2. And then go over the preview of the final, what you expect on the final, and then there is the final exam. Final exam will be in class. It will be 3-hour exam. You should be able to finish it in 2.5 hours. But if you need 4 hours to do it, I have no problem. But average time is 2.5-3 hours for it. Okay.
Wait, so next class is AMB or it's in 2 classes?
2 class from now is AMB, and then Travel Centers of America, and then the problem set 2 recitation, and then
Isn't,
what? Are we short on class?
yeah, don't we only have 4 more classes after this?
4 more classes after this? Yeah. So 1, 2, 3, 4. Maybe we do recitation outside of that regular class.
Because one of the, I'm counting the exams.
So today's
This
what?
is, this is AMB.
Yeah, so
This is
1,
travel.
2, 3, 4. Yeah, and this is the,
Travel, and then when you do, oh, so 2.
we'll find
And
an extra
review- and
session
review.
somewhere. Or maybe we can extend this class by an hour and do the problems.
And then review.
That will take 2 minutes. The review of what to expect on the final exam will take 5 minutes, not 2 minutes, 5 minutes. Okay? It will be fine, trust me. Okay. So what we will do today is go over some topics on corporate debt. What does it mean? Bonds and bonds pricing, term structure of interest rates, and then finally, next class session, Jordan's favorite topic, duration, convexity, and immunization. Okay? If you understand this, you're gold. Really gold. Okay, bond terminology. What the hell? Debentures, long-term unsecured. What are debentures? You hear the word debentures? They're long-term unsecured bonds, effectively. There's the other word for it, debentures. I did not do this, it's happening by itself. Mortgage bonds, a long-term secured debt, often contain a claim against a specific building or a property when there is a collateral. Collateral trust bonds are the bonds which are secured by common stock or other securities that are owned by the borrower. So, if you can put a group of securities in a collateral, that doesn't necessarily have to be real estate, but could be other securities, then that is a collateral trust bond. Then there is something called equipment trust certificate. It's a form of secured debt generally used to finance railroad equipment, airline equipment. The trustee retains ownership of the equipment until the debt is repaid, right? So what would be an example? Let us say Boeing makes airplanes, and there is a leasing company called Castle Harlan or whatever the name is, and they buy out the planes from Boeing. And what they do is they lease the plane to the airline. So they act as the intermediary. And when they become the intermediary, the airline doesn't really own the plane. They just are the lessees of the plane, right? So when a bond is issued with the cash flow from those leases as the collateral, that's called an equipment trust certificate. Does that make sense? Yeah? Okay. Bonds are debt, issuers are borrowers, and holders are creditors. The bond contract is called an indenture. It is the contract between the issuer and the bondholder. 424B is the SEC form that is the bond indenture. When a company issues a publicly traded bond, listed bond, they file a public document called 424B, and that is actually the indenture. Indenture is the full contract between the borrower and the lender. Okay? The indenture gives the coupon rate, maturity date, and the par value. And we will see what these mean. Okay. So let us do some conceptual explanation, and it will all become clear. So let me ask you this. What we have learned so far is, let us say, this is period, let's say this is the timeline. Zero, 1, 2, 3, 4, and 5. If a company borrows money, they will issue some bonds, right? And they issue the bonds at this point of time, 0, today. With a promise to pay you a certain coupon here, coupon here, coupon here, coupon here, coupon here. In the United States, companies and government bonds have 2 coupons a year, not 1. And for simplification, I'm just taking 1 coupon per year. Okay? Now, the company issues the bond at what is called a face value of the bond. What does face value mean? Face value means when the bond matures in year 5, you will get the face value back. Face value is typically $1,000 in the US. Okay? And the coupon rate is set at, let us say here, 8%. So this coupon would be what? $80? Annual coupon is $80. So you buy the bond here at time 0. You receive the coupons every year. And then when the bond matures, you receive another face value back, which is $1,000. Right? Basic time value of money. And depending on what is the riskiness of this bond, it would depend on the riskiness of the company that issues the bond. And for any stream of cash flows, to account for the risk of the cash flows, you have to calculate the present value on a discounted basis, and the discount rate is effectively reflective of the risk of the cash flows, right? So here also, you have, if you were to calculate the present value of this bond, of just this coupon, it would be this 80 divided by 1 plus, because it's 1 period back. For this, it will be 1 plus r to the power 2. Here, 1 plus r to the power 3. 1 plus r to the power 4. Here, 1 plus r to the power 5. Okay? Now, when the company issues this bond, who buys the bond? The investor, the bond investor buys the bond, right? So they will pay a certain price for it, price of the bond. And the price of the bond should be equal to the present value of all this. Right? Mr. Dutt? Okay. Now, at what this R is called the market rate. This coupon is called the coupon rate. My question to you is this: if this company issues the bond where in an environment where the market rate or the risk of this bond would be considered to be 8%. If you are an investor, to invest in this bond, you would expect an 8% return. Right? Everything else is the same. How much would you be willing to pay for this bond? $1,000? Is that what you're saying? Sorry?
Wouldn't it just be the?
You're absolutely right. You don't have to even open the laptop. You're absolutely right. And the reason why that's the case is coupon is 8%, right? Market interest rate, which reflects the risk of this bond, is 8%. When the coupon equals the expected, the risk of this, so you are basically being compensated for the coupon. Through the coupon, you are being compensated for the risk of this bond. Then you would be willing to pay the face value of the bond as the price for this bond. Does that make sense? Yes? No? Fallen asleep? Staying in Israel? Physically present? Mentally in Israel? Huh? Is that true?
No, I'm here.
Okay. Just check. So yes, as Augusta said, we pay $1,000 for this. Tricia, does that make sense? That's called the market rate. Now, what does this equation look like? Is the equation of a time value of money, of IRR effectively, right? So if you were to, now, before we get into that, let me present this. If the market rate, let's say, is 8%, then the price of the bond will be $1,000, as Arista said. What if the market rate is 6%? Or what if the market rate is 10%? What could be the price of the bond? How much would you be willing to pay for this bond if the market rate is 6%?
More.
More than the $1,000, right? Why? Because the market's expected risk of this bond is only 6% return. But the bond is giving you 8% return through the coupon. So when what the company is paying you, it is compensating you more than what it should for the risk that you are taking. The investor would be willing to pay more than the face value of the bond. Okay? So this would be, present value would be something greater than 1,000. And vice versa, it will be something less than 1,000. Okay? Yes, Jordan? It's okay? Mr. Shankar, are you awake? Eyes dry? Oh, okay, no, that's okay. I just want to check. Sometimes my own voice is so soothing that I fall asleep talking to myself. So, now, think about this. What does this equation look like? If I were to figure out, let's say the company issues the bond, and I pay a certain price for the bond because other investors are all contemplating how much to pay for this bond. I pay a certain price, which is, let us say I pay 880. What will be the R? From, you know about this, I know you know about this. What will you call that R? The IRR, right? It will be the IRR because when you do your property investing in real estate finance, what did you do? You had some investment which you put here. You got some cash flows, you sold the property. In this case, there is really no capital, it is a side capital appreciation. You put 880, you got 1,000, right? So the implied return, implied average return during this period is your IRR, okay? So the concept of a bond utilizes the concept of IRR. In fact, IRR is based on the concept of a bond, okay? Now, there is a concept you've all got to remember. It is called current yield. Current yield is, who can guess what it is?
How the bond is currently performing.
Okay, so how do you calculate that? You're in the right direction. How would you? Current yield is, what is your yield when you buy this bond today? Yes, Max.
Is it like the yield over the cost?
What is the cost?
The initial purchase price?
See, let us say this is point of time 0, this is 1, right? You bought the bond at 880. So your initial current yield is what? You spent 880 and you're getting 80. So your initial current yield is 80 divided by 880, right? Which is your income return. Current yield here is 80 divided by 880. Here, let us say the price became 900. So the yield here would be 80 divided by 900. Maybe it became 860 here, 80 divided by 860. So once the bond starts trading, the price changes. The denominator changes. So the current yield is your coupon divided by the present price of the bond. Yes, Weston.
But the dividend doesn't change, or?
Dividend is coupon. So coupon is 8% of what? 8% of the face value. So I'm not saying the dividend could not change. The dividend could change, but in order for the company to default on its coupon, it's a default, right?
Okay.
But if it doesn't default, then it's going to pay you the coupon. And the coupon, 8%, is not linked to the price of the bond, it is linked to the face value of the bond.
Got it.
Good question, good clarification. Okay? Now,
Does face value ever change?
if you are a philosopher, you would say everything changes. And financial markets are more about philosophy than anything else. Everything changes. Let's see what happened. Why would a face value change? A company borrowed from you to promise, with a promise to pay you $1,000 when the bond matures in 5 years from now. But if for some reason the company doesn't have the money at that time to pay you back, it only has $700 to pay you back, then the face value would be reduced, right? You remember the cost of debt? Is equal to the risk-free rate plus default risk premium. Remember this? Default risk premium is made of two things. What is probability of default? And severity of default. Probability of default could be anything, let's say 10% chance that the bond will default. The severity of the default means loss given default. What will be your actual loss incurred by the investor if there is a default? Now, for a technology company which doesn't have too many assets, just some software, which could be very specific to an industry, and if the industry weakens, there is probably no value to the software. So what happens? What would be the severity? It would be very heavy. You lose everything. There is no collateral thing behind it, right? So technology companies have a high severity of default. 100% can go around. But for a real estate company, there are some real assets underlying it, right? So let us say there is a total default is 50% of the value is lost. But you would recover because you have some underlying collateral, you may recover another 30% out of it, right? So whatever is your severity, what is your actual loss given default? Let's say actual loss is 20% for real estate. Right? That. So if the face value of this investment, real estate investment, was $1,000, how much can you expect to get a year? How much can you expect to lose? 20. You will be still left with 80, right? So this principle applies to that. This principle applies here also. So when the loan matures, by this time, if the company doesn't have enough resources to pay you back $1,000, it will pay back whatever resources it has. From your perspective as an investor, it is a default. It is a reduction in the amount that you were expecting. The 1,000 was the promised. And let us say you get only 800. 800 is your actual, right? What happens is when the bond is issued, there is a promised face value. And if the bond has if the inkling of a default, then that promise actually becomes expected. Right? As an investor, your expectation is not 1,000. 1,000 is the promise by the company to pay you back. But you as an investor have an expectation that, you know what, I'm not going to get back a 1,000, I'm only going to get back 800. And that is the 20% severity of default. Okay? So, that is the current yield. Current yield is your coupon divided by the current market price. This is the more general statement. Now, who is interested in knowing the current yield? Yes, Gabby? Of course, of course. Colin?
Traders?
Bond traders. What does current yield actually tell them? It tells them, let us say you started, the company issued the bond here at T is equal to 0. And the bond was issued at whatever price it was issued. And then over time, the price fluctuated, changed, right? So when you are an investor or a trader, you're buying this bond, let us say you're buying this bond somewhere here in 2.5 years, right? What would you be interested in knowing? If you were to buy this today, what will your yield be, right? Current yield. Current yield would be your coupon that you would receive over the next year. Divide by the price you pay here. That is one. Current market price. So current yield changes from period to period along with the change in the price of the bond. Okay? Now,
Professor, can the coupon rate change if they change the rate? How often does that happen?
before the coupon is changed, the company will try to pay you the coupon rate. If there is excessive default, let us say the company is not able to even pay you $1 from your $1,000. Perhaps it has incurred more losses. There is no cash in the company to pay you. It may actually default here. Then you will not get this coupon either.
Right.
Now, there could be even lower money with the company than it is obligated to pay the coupons. Yes, everything can change. But bonds are the safest, right? And I will walk you through the mechanism why they are considered safe in a bit.
Is there ever a time when like the future payout is greater than the face value when you put in, or no, that's not no?
Aha. It's a wonderful question. Can there be a situation where the payout is greater than the promised?
Or would that be like for inflation protected?
But why would a company ever do that?
Why would a company do that? It depends on everything. See, we live in a wonderful country, everything is negotiable, everything is possible, right? I said to you in the capital structure discussion, your real value creation is how you can create a contract. This is a contract at the end of the day. There is a demand side and there is a supply side. When you can bridge the gap between demand and supply, or you can supply a product where there is demand, but the demand has not been fulfilled by the marketplace, that's where you make a killing. You don't make a killing by just investing here or there. That's making, it's like an 8 to 5 job, 8 to 6 job. But where you really make a killing is situations like that, which are at the extremes, and you can benefit from that opportunity. Okay? Now, does that answer your question, though?
So yes.
It was not a overwhelming yes, so I'm looking at the severity of my default. Right? Yes means 100%, no severity. Anyway, so the other concept you have to figure out is this. What is called the yield to maturity, right? The next concept is yield to maturity. Very important concept for a bond. Let us say you buy the bond here, you pay a certain price, and the company has promised to give you a certain coupon, and it gives you the coupon, it also promises to pay you the face value at the end. Can you calculate the expected return from this investment? What would the expected return be? The R. The R is what? R is IRR. Exactly right. Okay. Right? Now, this R will be determined by whom? Who determines the R?
The investor?
The marketplace. And the investors in the marketplace, they are the ones, the collective wisdom of the investors, their awareness or their assessment of the risks of this bond determines what the R is going to be. That's called the market rate. For this specific company with a certain risk characteristic, we would expect a certain rate of return, certain yield. Right? That's how the marketplace. So riskier companies will have to pay their expected, when you invest in their bond, the expected return will be higher than for a company where the risk is not that high. Right? Now, shortly we will look at how that process is calculated, but let's go back to the concept of yield to maturity. If you were to buy the bond today at 880 and you will get these cash flows, what your yield to maturity is? R. Now, if you were to buy this bond at 1000 and you get these cash flows and at the end you get $1,000, what is the yield to maturity on this bond?
8%.
8%, exactly right. Why? Because you paid the face value, you're getting the face value back, and therefore you're willing to pay, you will only be willing to pay the face value if you believe that the coupon is the same as the market rate. Does that make sense intuitively? Yes? You run it on an Excel, you will see it. This all what I'm saying is actually correct for a change. So, yield to maturity is a concept that tells you if you were to buy the bond at whatever price you pay for it, and you were to hold the bond to its maturity, what is the annual average total return you would get from the bond? That is the yield to maturity. It's the most important concept you will learn in the world of bonds. If this will be on your exam, you will have to calculate yield to maturity. Now, here we just took the example where you bought the bond at the inception, where the bond was issued. You paid $1,000, $880, perhaps $1,100, and you can calculate the implied return. Right? Because you know the cash flows. You know how much was invested, how much you paid for the bond. So you can calculate the IRR calculation. Now, what if you bought the bond here? 2.5 years. or 2.25 years into after the bond was issued. You probably paid a price, let's call it the price P1. There's some price you paid for the bond. These are what will you receive? You will receive these coupons. This is already passed. That never came to you. Relative to P1, can you find out what your R is? Yes, if I give P1 is like say $980. You can calculate what R is because you know the investment amount, right? So it is the IRR. Yield to maturity is the IRR if you were to hold the bond from whenever you purchase it all the way up to its maturity. That is the yield to maturity. Now, we will expand this concept later, but let's, for now.
But the difference between the current yield and the yield to maturity is that the current yield is not taking into account the future payment of the face value.
Yes, it doesn't. Exactly right. Current yield is only based out of coupons, relative to coupons. Yes. Now, so we now know the maturity date, in that case is 5 years. Coupon rate, you all know what that means, and you know what par value is. Par value is the same thing as face value. It's a different word for the same concept. Okay? Bonds in the US are issued typically at $1,000 par value or par face value. Coupon rate determines the interest payment. Face or par value is typically 1,000. This is also the principal repaid at maturity. Interest is usually paid semi-annually in the United States. Coupon rate can also be zero. You remember we had the discussion during our recitation, right? Zero coupon bond. If you were to have if I did not pay you any coupon here, I only promised to pay you $1,000 at the end of the 5 years. Would you be willing to pay me, let's say you pay me still price P, right? If I tell you that the market expected return on this bond, from this bond where there is no coupon payment, zero coupon, is 8%. How much will you be willing to pay for this bond? Go ahead.
Discount it back the number of periods by the market rate, and that's the price I'm willing to pay.
Yes. So you're not getting anything here. So this is zero, coupon is zero, so this becomes zero. This is zero, this is zero, this is zero. Here, it is also zero. So all you will get is 1,000 divided by 1 plus r to the power 5. R is 8%. So you can basically do a present value math here to say how much you can maximum pay for it. Make sense? Patricia? Yeah? Mr. Doug? And interest payments are called coupon payments. When the US Treasury, US government issues bonds or notes where the maturity is between 1 and 10 years, it's called a note. US Treasury note. When it is from 10 to 30 years, it's called a bond. And when it's less than 1 year, what is it called?
Bill.
Bill. All right. Bonds and notes may be purchased directly from the Treasury. You can actually buy it directly from the Treasury. Denomination can be as small as 100, but 1,000 is more common. and this is just how they are bid. It used to be, now it is on the decimal system. It used to be on the FPS system, which was the more, it is an imperial system. Okay. Now, the different kinds of bonds. One is the callable bond. What is a callable bond? A callable bond is a bond which can be repurchased by the issuer before the maturity date. Let me see if I have a slide. No. I have somewhere later. In a callable bond, the issuer, the company, can buy back the bond from the investor. That's why it's called callable. When the company issues the bond, it has a right to call. Okay. Why would a company call back its bond?
Because it can find cheaper debt in the market in a certain period. So
Yes.
it pays.
Yes. And how does that work? Let us see the logic of how it works. Let us say the company issued a bond at an 8% coupon. By the time it arrived at third year, the market expected return from a bond with this level of risk was only 2%. What happens to the value of this bond? Goes up significantly. The greater the difference between the coupon rate and the market rate, when the coupon rate is significantly higher than the market rate, then the value of the bond will go up significantly. All this implies that the company is paying significantly more than what it ought to relative to the risk of this bond. Right? And that's why the company will make a decision. Why should we be paying such a high coupon? Let us call the bond. Let's bring back the bond. Now, if you look at the fair market mathematics of this, what will happen? The price goes up here very high because now R is only 2%. And you will get this cash flow, this cash flow, and this cash flow. All this is history. These two are history. These are the future cash flows, right? These three. Now, when a company issues a bond, a callable bond, it does so to protect itself, just like Alejandro said. But, you know what, an investor would say what? I bought this bond in the hope that the bond will do well, the price will be much better than what I bought it for. Why should I take the loss? In order to avoid that situation, the company typically says that this bond will not be callable for the first 2 years. Typically. First 2 years you cannot call the bond. After that you can call the bond. And if now the company says, yes, if this difference can be huge, and if the difference is huge, perhaps the bond price goes from 1,000 to 2,000. The company borrowed $1,000 and now it has to pay back $2,000 in terms of present value of the cash flows that it is paying to its investors. Does it make sense? So its obligation now increased substantially. To cap its obligation, the company makes the bond callable first. Second point, it puts a cap on the price of the bond at which it can call the bond back. So it cannot let the exposure go to 2,000, 3,000. It says, the company says, whatever be the difference between the coupon and the interest rate, when we have the right to call the bond after 2 years, anytime after 2 years. But when we call the bond, the maximum price we are going to pay is $1,200. So there is a cap on the price that an investor will receive when the bond is called. Yes, generally like that. So, what happens to the value of that bond? Where there is a cap on how much the price can rise. What happens to the value of that bond? There will be a ceiling on the value of the bond. The bond price cannot exceed 1,200. Right? So, that is the callable bond. I will go into and show how the price function behaves for the callable bond later. For now, that is the idea of a callable bond. Now, there is something before we get to convertible. Let's look at this puttable bond. It is the opposite of a callable bond. It gives the bondholder the option to retire or extend the bond. An investor can put the bond back to the company and say, we have the right to give you the bond. Why would an investor want to have that right? And who gives that right? Where are these rights bestowed upon from? Gary?
Well, wouldn't you put the rights in the indenture?
Yes, it's in the indenture. Very, very good.
I think that they would want to make it a puttable bond because it's not like yielding what they thought, or it's just not worth it for them to invest in.
Yes, a puttable bond is when, let's say you invested $1,000 in this bond. You bought this bond for $1,000. Hopefully you will get $1,000 back then. Now, there is a problem with the company and the bond value has gone to $50. If you have the put right to put the bond back to the company, you can, depending on what the put exercise price is, you can say, let us say that exercise price is $800. So whatever be the price of the bond, howsoever much lower than 800, you can still give the bond back to the company and receive $800. That is a puttable bond. Okay? Convertible bonds. Convertible bonds are the bonds that can be exchanged for the shares of the firm's common stock. In a convertible bond, the bondholders can convert the bond into equity of the company, shares of the company. That's why it's called convertible. The conversion price or the conversion ratio are preset. Right? So it could be like the company issues a $1,000 bond, and with a condition that there is a convertibility feature that if the stock price goes above $100, then you will be able to convert our $1,000 bonds into 12 shares of the company. Why 12 shares? Why not 10 shares? Right? Because the convertibility feature has to be attractive to the bondholders. So even though the share price is 100 and their face value is 1,000, they are getting something more than that. So getting 12 shares where they should have gotten 10 shares based on the $100 price. So they're effectively getting the shares for a cheaper price than $100, right?
They also get the dividends through
The coupons. Until it is converted, yes. Yes. Now, why would a company issue a convertible bond? In your view, stretch your imagination. You know, corporate finance is not about the mathematics. Mathematics is incidental to it. It's about imagination. Colin.
If I'm a startup and I need capital, I'd issue a convertible bond in the hopes that obviously as my startup grows, the valuation grows, and then the investors that invested early and the convertible bonds can cash out the equity.
Yes. When you are a early stage company, you don't have too much cash flows, but you have just enough cash flows. So you really cannot pay a very high coupon, right? Because you are a not really a startup, but in order to have any kind of a bond, you have to have some kind of cash flows. Startup has no cash, so it cannot service the debt, so it cannot issue bonds. But let us say it is an early stage of development or reasonably early stage of development where it has some cash flows. It can pay the coupon, right? But that coupon amount is not enough. If it were to issue this bond where relative to its risk the coupon is low, what happens to the bond price? It will go down. The money received by the company will be less. In order to make it more attractive for the investors, the company adds to it a convertibility feature. It's a convertibility option. A regular bond plus the option to convert is called the convertible bond. Okay? So how does that convertible bond work? Why would a company issue it? Company would say, investors, we want you to take an upside. Typically, a lender gets no upside. They want to get their interest back and the principal back. Of the interest and the principal, for a lender, what is more important? The principal. Getting the principal back is number one priority. Even if they don't get any money on their money interest, they want to get the principal back. They usually don't have an upside because all the upside is with the equity. A convertible bond allows a bond investor to also have an upside, right? So if they believe that this company is going to do really well, and when it does well, when the share price increases above $100, we can still pay $80 to buy the shares, effectively convert and buy the shares. So that is a very attractive deal, and for that they would be willing to accept a bond where the coupon is less. Yes?
I don't really understand that because, capital's capital, so whether you're issuing bonds or stock, you're still gonna receive money, and especially if you are issuing bond, I feel like for a startup too that has no capital, it would be more attractive for the startup in terms of their interest to issue a bond as a zero coupon rate, because then they don't pay any interest and they're just promising the value right back to the investor. So why even issue convertible bonds where now investors are receiving premiums when they could I guess in terms of just to entice investors, but I don't see any point for the company to do that. Because also, like you said, this kind of cash flows, even though you're predicting it's a promising.
So your question is, why would a company issue a convertible at all?
Right. Especially for a startup, I just don't see any. I understand
First of all, a startup cannot issue even a zero coupon bond, right? It's a very, very high risk. It's in order to issue any kind of bond, let's say even if you're issuing a zero coupon, for example, let's say you were able to issue a zero coupon bond, you will have to end up paying $1,000 at the end. You're a startup, nobody knows what will happen to you in 5 years, whether you would even have $1,000 to pay the bond or may not have 10 cents to pay a bond. Nobody knows. Those bonds will be extremely risky, right? So that's why early stage companies always are funded with equity. It is only when you get to some reasonable amount of stability of cash flows, regular cash flows, that you can even contemplate having a bond. In the life cycle of a company, when the company achieves close to maturity, that's when you have bond. If you remember the AMB navigating treacherous waters case, right? It was a bad situation 2008, 2009. They were not able to, they didn't know, they needed $500 million. Where to get the money from? They could have not gone to the bond market. Bond markets were closed, or the cost of the raising capital in that market was very high. The market risk was very high. So what they did, because they had an established structure from before, they were able to issue equity. But then after that, they went to issue bond, right? To validate that the business model was recovering. They could have issued convertible bond. The market would have had an appetite for the convertible bond. If the market would have an appetite for their bond, it would certainly have an appetite for the convertible bond. Okay? So that is the convertible bond. The ratio at which the bond converts into the common stock is prefixed. Now, the last one is the floating rate bond. Have an adjustable coupon rate. What's an adjustable coupon rate? Here the coupon was fixed at 8%. 8% of face value, so $80 is a fixed coupon rate. You could have a bond where the coupon is linked to the US Treasury or the prime rate or the LIBOR. LIBOR is going out of fashion. Why?
Scandals.
Scandals. What was the scandal? Do you remember, Colin?
Did it involve Barclays, and there was like a bunch of traders basically colluding to try to set the rate.
Yes. LIBOR is London interbank borrowing rate. So there were 17 banks in the UK that would borrow from each other overnight or for short durations of time to fund their operations and their business. And they borrowed. When 2008 the crisis hit, what happened? The rate should have gone up because every rate was going up. Because these guys' books, value of their holdings were measured on a day-to-day basis, and because bonds are valued on the cash flow and the discount rate, right? If the discount rate goes up, what happens to the value of their holdings? Goes down. So in order to not to minimize the change in how their values were reflected on the books, they kept the LIBOR rates in a bandwidth, in a band. Did not increase it, even though they should have increased. Because if they had increased it, the value of the bond will go down. Welcome to Wall Street. All right. So there was a big scandal. Some people went to jail, and LIBOR, which used to be the preeminent benchmark for tying your borrowing rates, is being phased out. No longer will you see borrowings tied to the LIBOR. You will have more like US Treasury or prime rate, and I will explain what a prime rate. Prime rate is when a bank lends, the rate at which a bank lends to its prime customers. That's a prime rate. And US Treasuries, you all know. So how would a coupon or the floating rate coupon work? Floating rate coupon work is prime rate plus some delta basis point spread. So in this, what is fixed? There are two components of this floating rate we just constructed. We tied the floating coupon to the prime rate and some spread on top of the prime rate. Let us say prime rate plus 300 basis points. So what is fixed and what is floating?
Spread is fixed.
The spread is fixed. The prime rate is floating. It changes from period to period. Okay? That is a floating rate bond. Why would a company issue a floating rate bond?
Could be in their favor if they think rates are going down. They think like LIBOR is going to go down.
Yes. So if the company believes that rates are going to go down, they may want to reduce their coupon payments and therefore issue a floating rate bond tied to some interest rate. Okay. Other kinds of domestic bond issuers are Federal Home Loan Bank Board, Farm Credit Agencies, Ginnie Mae, Fannie Mae, Freddie Mac, and the municipalities. Okay. If you were in China, the Chinese government issues bonds. They have the Chinese government bonds, and they have the municipalities or the state-owned enterprises which issued bonds, which is called LGFV. LGFV. Okay. Now, then there are foreign bonds and there are Euro bonds. Foreign bond is a bond that is issued from a country other than the one in which the bond is sold. Bonds are denominated in the currency of the country in which it is sold. A Yankee bond, samurai bonds, bulldog bonds. What are these? Let us say a Japanese company wants to raise capital in the US. They will issue what is called a Yankee bonds, and the bond will be denominated in the United States dollar. If US company wants to raise capital in Japan, they will, and they want to raise money in Japanese yen, that will be called a samurai bond. In the UK, I don't know why they are called bulldog, but bulldog bond. You know what a bond in Chinese bond would be called? If I were to raise money in China, is what? Panda bond.
I don't know.
What about India? A bond issued in China would be called the dim sum bond. And for India, it would be called the masala bond. I don't know why they don't call it the curry bond. It should be the masala bond. And then there is the euro bond. Here the bond is issued in the currency of one country but sold in other national markets. Euro dollar bond, euro yen bond, when you hear these terms. So let us say United States company wants to borrow in US dollars, it borrows in US dollars, but it issues it in Japan. So the Japanese investors lend money in dollars to a US bond company rather than lending money in Japanese yen. Okay? That's the difference between these. Now, there are something called preferred stocks. We discussed briefly preferred stocks when we were doing capital structure. Preferred stocks have characteristics which are like that of equity and fixed income, right? They are stocks, they are equities, they have upside. That's why they're called equity. Fixed income is because they have preferred dividends, which doesn't change very much. Right? Typically, a preferred stock is issued for $25 a share, and its dividend is between 6 to 8%. Okay? Dividends are paid in perpetuity. Non-payment of dividends does not mean the company has gone bankrupt. Just like common stock, if you don't pay dividends on a common stock, doesn't mean the company has gone bankrupt. Preferred dividends are paid before common dividends. That's why they are called preferred. There is no tax deductibility of dividend payments at the corporate level because they are dividends. No dividends are taxable for corporate purposes. Tax deductible for tax purposes. Is interest deductible for tax purposes? Yes. So these are, because the interest is not deductible, the preferred dividend is not deductible, they're like equity features. However, the preferred stocks have one important characteristic to it. In the United States, when one corporation owns the preferred stock of another corporation, then 70% of the dividends received are not taxable. Now you can ask the question, why is that the case?
Why only preferred? Would that not also be the same for common stock?
No.
Why?
That's my question to you. Now don't go to Google. It is to incentivize cross-shareholding amongst corporates. In Japan, they have the karetsu. Have you heard of the karetsu? Guangxi in China. In Korea, the kaibol, where companies own the preferred shares of the other company, so they are like in a network. There is cross ownership amongst companies. When there is a cross ownership, it allows them to share information, to act in concert with certain things, especially of national interest, and deter unwanted merger and acquisition activity. Right? If you have cross shareholdings and you don't want somebody else to come and take it over, where you have the rights as a preferred shareholder to refuse a merger, you have a lot of power. You can refuse a merger.
Wouldn't governments be anti-cross shareholding just because of price manipulation?
What price manipulation?
Like, I'm assuming that if you're one company, you have preferred shares in another company, obviously you want the company to do well.
Yes.
So what I'm saying is like, I know doesn't the government sometimes just deny certain mergers and acquisitions because they are scared of like monopolies in the market?
Yeah, but it's not really monopoly. Monopoly is one company has unlimited pricing power in the company. That's in a market system. That's a monopoly.
But that could happen across shares, you know what I'm saying, if you.
Yes, it could, and if it does happen, then antitrust will come in. Right? That's a good point. But sometimes countries favor that. The Japanese favor the currency. All these Sony and Takenaka and Honda and all these companies have cross shareholdings. You cannot touch them. Look, Renault bought Nissan, Japanese company. And the CEO of Renault was Carlos Ghosn, the Lebanese guy. Have you heard the story, right? What poor guy is in jail in Japan? Huh? Don't mess with the Japanese. This is cross-cultural fighting between the French and the Japanese. How could the French guys take over the company? Because the French guys were thinking Renault would take over Nissan and ultimately, even though it's a merger, they will take over. But the Japanese culture is so strong. They have a certain way of doing business, certain hierarchies to work. You really cannot penetrate it. And if you try to penetrate it, you go to jail. Find something against you. I think the guy is in the clean. He just got caught in this cultural mess. Now, but the great attraction is if one corporate owns the other, the dividends are substantively deductible for tax purposes. No dividend is deductible for tax purposes otherwise. Now, innovations in the bond market, inverse floaters. Inverse floaters are the bonds where the coupon falls when the interest rates rise and vice versa. Why would a company issue an inverse floater? So if the rates are rising, the coupon is going down. A company that is, sorry? Colin?
I'd say to hedge itself against interest rate risk.
Yes, exactly right. But which kind of company would want to do it? Companies that are exposed to excessive interest rate risk. Most financial institutions are like that. Asset-backed bonds. Asset-backed bonds include what? RMBS, residential mortgage-backed securities, commercial mortgage-backed securities, auto loans bundled into auto-backed securities, credit card risk securities. All that is asset-backed bonds, where the bond is backed by a certain cash flow that is expected to come in. Okay. Then you have pay-in-kind bonds. It's also called PIK bonds. If somebody gives you money for a PIK, don't take it. The first line of defense is I'm not going to take it. Somebody's other side is a hard money lender, wants to own and squeeze you and finish you. PIKs are used by private equity players, which are really, really aggressive. What is a PIK effectively? PIK is, let us say I borrow from you and I promise to pay you back, but for whatever reason I'm not able to pay you back or my cash flow is short. If the security I have borrowed is a PIK security, then what happens, what I have not paid to you gets added to my principal balance. So what happens pretty soon, the principal balance starts to swell. The less I can pay, the greater amount I owe to the other party. Okay? When you lose your company, your asset, your everything. Don't. Okay? Unless you need it for a very, very short period. Catastrophe bonds. In the event of a specified disaster, the bond issuer's required payments are reduced or eliminated. This could be, who could issue a catastrophe bond? Property and casualty insurance companies that insure you against property and casualty loss, natural disaster loss, right? Index bonds, payments that are tied to a price index or the price of a commodity. TIPS, Treasury Inflation Protected Securities. The par value of the bond increases with the consumer price index. We saw this earlier. Remember? Yes? All these slides have been posted, huh? But I know you enjoy writing a lot, so it's good to have good habit. When your hand feels the pencil or the pen, there is the memory sharp. This is what I was explaining to you before. This is for the tips. Time period, inflation, par value, coupon payment goes up, principal repayment goes up, total payment is different. So you are getting compensated for inflation. Okay. Now, REIT debt comes in three forms. One is the secured debt, which is mortgages, unsecured debt, and hybrid debt, which is convertible debt. Now, we saw when a company issues a REIT debt, we noticed this calculation here. Right? We saw what the market rate is, how the market rate is determined. Right? We just left it saying this is what the investors expect for this kind of a risk. But there is a lot more rational and substantively rational way of actually assessing what the market risk is and how do you get compensated for the market risk. Okay? So this is done by the rating agencies. The rating agencies determine through all their experience and through their interaction with potential investors what could be the expected return or to compensate for the risk of any particular bond. Because they look at bonds across the spectrum. So they form a view based on certain criteria. Some of those criteria are these. 4 key factors. Liquidity and funding. What is the liquidity situation and the funding situation of the borrower? Of the company that is borrowing. The leverage and the capital structure. How much leverage do they have? Would you expect a company which has a higher leverage to have a greater risk? Yes, no?
Yes.
Yes. Capital structure. Right? Now, all your leverage, you may have reasonably good amount of leverage, but the debt may not be coming due soon. So you can mitigate some of your leverage risk by having a capital structure which is allocable, which is spaced out over time, whereby the maturities of your debt are spaced out over time. Not all of the debt is coming due all of a sudden. Because if it does, then you will have to find a way to refinance it. And if you refinance it and the market changes, you may not be able to refinance it, in which case you will default. Okay. Market position and asset quality. What is the borrower's market position? Do they have pricing power? Can they be competitive in terms of pricing? Can they raise the price? Are they diversified geographically? Who are their leading competitors? And what is the asset quality? If they have underlying assets, what is the quality of those assets? Right? Well, there is a building which is a B-class building in one company has, and the other company has only A-class building. Which do you think has better asset quality? The one that has better buildings, right? Cash flow and earnings. They look at the cash flow of the borrowers. The greater the cash flow, the more the cushion, the better it is. Earnings. Earnings is potential for future earnings. Income, which is different than cash flows. Here you depend on the quality of earnings. What is the quality of earnings? Where are the earnings coming from? Are the underlying assets strong assets? is the company's management responsive to changes, and as a result of that knows exactly how to maintain a level of earnings? Right? Are they getting earnings from taking a lot of risk in unwanted projects? Perhaps for the short run, the earnings look good, but in the long run may be detrimental. How are they generating those earnings? Do they have to spend a lot of capital to generate a certain amount of earnings? Right? All that goes into this. And then all these four factors are combined into some kind of a rating. They are prescribed to a scale, and the scale is weighted, and there is more detail in the slides you can look at. You can see these are liquidity and funding. There are subcategories to liquidity and funding, like liquidity coverage, debt maturities, FFO payout, amount of unencumbered assets. Right? Within liquidity and funding, they have these four parameters. And then on the top you will see these are the ratings. These are Moody's ratings. AA, A, BAA, and so on. S&P 500 would be AAA, AA, A, and so on and so forth. Right? And they assign a certain, depending on the liquidity and funding situation of the borrower, they will assign a certain rating, or maybe some number here. For liquidity coverage, where they are in the spectrum. Debt maturities, where they are. FFO payout, where they are. How much of the FFO payout they have. High FFO payout is good or bad? Good for the equity holders, not so good for the lenders. Lenders want more of the money to stay in the system. So if there is ever a need, they get paid first. Right? This is the next one, leverage and capital structure. The parameters are debt and preferred divided by the gross assets. How much debt do they have? How much preferred? These are the fixed obligations that a company has. Divide by the size of the total asset, gross assets. It gives you a sense of how leveraged they are. Net debt to EBITDA. Net debt is what? What is when you hear the word net debt, what does it remind you? That market value of debt minus the excess cash is the net debt, right? You remember from firm value, enterprise value calculation? That's what this is. How much of your debt minus excess cash flow, how many times is it relative to your EBITDA? Over how many years can you, if you were to generate the same EBITDA every year, over how many years is going to take you to pay down your debt, pay off your debt? Okay. Secured debt versus gross assets. Would you want your secured debt to gross assets to be higher if you are a lender? No. Right? If you're a secured lender, yes. And you would hope everything would be secured. But otherwise, no. Access to capital. This shows what access to capital do you have? If you need money as a company, can you go to the capital markets? Have you done it before? If you have had a pattern of going back to the market and raising money successfully, then it's a good quality. Then you will get a better rating here. And then you have market positioning and asset quality. It has four: franchise and brand name, gross assets, diversity of location, tenancy, diversity of industry, diversity and economic diversity. Development as a percent of gross assets. What does this tell you? Would you want, as a lender, for the company to have large amount of development projects in its portfolio as a percent of the gross assets? No. You want more income producing. The more income producing, the more debt service you can receive, and asset quality, right? And so on and so forth. It goes into the other parameters. And then what it does is, to determine the overall scorecard indicated rating, the indicated rating for each sub-factor is converted into a numeric value upon the scale below, right? And then this is all compiled into one to come up with a credit rating, which would be any of these. Most of the REITs lie under S&P, which is BBB rated, which is investment grade. Okay? We will stop here now. I think I've already put you lot to sleep. Next class, this is going to get even more technical and more fun. Those of you who are technically minded. Okay? And I'm going to email you to let you know when the class meets, either it meets from 1 to 4 or 2 to 5, next class. And secondly, tomorrow by 8 p.m. you have to resubmit your midterm exam answers. Don't forget that. I'll see you guys next week.
不是全对的。你回去得看一下，他答案不是全对，但我不知道哪个。
That's a great question.
我就照着他写的，然后呢，反正不是满分，100多少，100出头，103还是什么104之类的，错了可能1、2个，这是最高的，满分108。 但是105，满分165，一点都不太好，我就重新再交一个，那个错只错了一个1分。还是满分是100，我拿102，我不知道，反正我就是100出头一点，就大概错了1个或者2个，就是。